Welcome to Investero. Every once in a while, you can almost feel the market shifting under your feet. The headlines talk about inflation, interest rates, tech earnings, and global uncertainty. But if you look closer at what the so-called smart money is actually doing, the hedge funds, institutional investors and billionaires who move billions of dollars at a time, you start to notice patterns that tell a very different story than the one playing on the nightly news. And right now, those big players have made some massive moves that could reshape the market for the rest of this year and beyond. Smart money isn't just about guessing or speculating, it's about having access to research. It's data and resources that the average investor simply doesn't. These are the players with entire teams of analysts, algorithms, and insider-level insights into industries before the broader public even knows what's happening. When they shift positions in a big way, it's worth paying attention, because more often than not, they're early to trends that later dominate the market. It's one of the most striking moves recently has been a renewed interest in technology. After a year of volatility and doubts about whether tech valuations had grown too high, institutions have been quietly loading up on artificial intelligence-related stocks. Not just the big names like Nvidia or Microsoft, but also the infrastructure players, semiconductor manufacturers, data center REITs, and companies powering the growth of AI tools. Hedge funds know AI, ISNT, a passing fadette, the backbone of the next era of computing. And while retail investors are distracted by daily price swings, the smart money is steadily accumulating positions that they believe will still be thriving 5 to 10 years from now. But that's not the only area drawing their attention. Energy is back in the spotlight, though in a very different way. Rather than piling into traditional oil and gas producers, institutional investors have been directing capital toward renewable energy and the companies involved in the transition to cleaner power. Solar, wind, and battery storage technologies are becoming hotspots for long-term plays. Big funds aren't T-betting on what will happen next. They re-betting on the structural shift in how the world produces and consumes energy over the next decade. To them, the opportunity is enormous, and they're positioning before the wave of adoption fully hits. At the same time, the financial sector is seeing some strategic moves. Rising interest rates created headwinds for banks last year, but now some funds are seeing value in high-quality financial stocks that benefit from higher yields and improved margins. They're not buying every bank, they're targeting the strongest balance sheets. It's the ones that can weather economic uncertainty and still grow. This is the kind of nuance that separates smart money from retail traders. They're selective, patient, and disciplined. Another big move you might not expect is the quiet accumulation of healthcare stocks. From pharmaceuticals to biotech firms developing breakthrough treatments, institutions are betting on the long-term demand for healthcare innovation. An aging global population means healthcare spending will keep rising, and companies on the cutting edge of medical research could see explosive growth. For hedge funds, this is a defensive play with massive upside potential, especially if breakthroughs in genetics, treatments, or medical devices make headlines. What's also interesting is how much capital is flowing into alternative assets. It's not just about stocks and bonds anymore. Smart money is diversifying heavily into commodities like gold and lithium, as well as private equity and real estate. Lithium, for example, is at the heart of battery technology. And with EV adoption accelerating worldwide, demand is only expected to increase. Meanwhile, gold remains a hedge against currency instability and inflation. And institutions still see it as a store of value when uncertainty rises. These aren't reactionary moves, they're calculated bets on long-term global trends. Crypto is also part of the picture, though more selectively. While retail investors often chase the hype of meme coins and speculative altcoins, institutional investors are focusing on assets with staying power: Bitcoin, Ethereum, and tokens tied to real-world applications. More funds have quietly increased exposure to Bitcoin as a kind of digital gold, seeing it as a hedge against inflation and a way to diversify portfolios. Regulatory clarity is still developing, but the fact that major funds are putting serious capital into digital assets shows they see crypto as a permanent part of the financial landscape, not just a passing trend. All of these moves raise an important question. Why now? Why are the big players making these changes at this moment? The answer lies in timing. Institutions aren't looking for today's headlines, They re-looking at where the world is headed in 5, 10, or 20 years. They know that by the time the average investor hears about a trend, it's often too late to capture the biggest gains. So they position early, sometimes years in advance, and wait patiently for the rest of the market to catch up. This doesn't mean every move they make is perfect. Even billionaires and hedge funds get it wrong. But by following the flow of institutional money, you can often get clues about which sectors and companies have the strongest future potential. If you notice large, consistent buying in a particular industry, that's not by accident. That's a signal that the smart money sees something worth betting on. For the average investor, the lesson here is not to blindly copy what hedge funds are doing, but to pay attention to the themes and sectors they are regravitating toward. Technology powered by AI, renewable energy, healthcare innovation, selective finance, commodities. In digital assets, these are the arenas where big capital is moving. By aligning your portfolio with some of these themes, you're effectively swimming in the same direction as the most informed investors in the world. It's also worth noting that the smart money plays a long game. They don't panic sell on a bad earnings report or chase short-term hype. They build positions, hold through volatility, and let time work in their favor. That's something every investor can learn from. Instead of jumping in and out of trades based on emotions, think in terms of years, not days. The most successful portfolios are built with patience and strategy, not impulse. As we move further into 2025, the moves smart money is making today will start to reveal themselves in market performance. We'll likely see some of these bets pay off in huge ways, while others may take time to mature. But one thing is clear, the big players aren't sitting still. They're already positioning for the next wave of opportunities. Those who pay attention could benefit by following the trends they've identified. The key takeaway is simple. The smartest investors in the world are showing their hand, at least partly. You don't need their billions to learn from their strategy. What you need is awareness, discipline, and the willingness to think long-term. You can do that, you'll be aligning yourself with the same forces that shape markets at the highest levels. Subscribe to invest